Imagine you just had a brutal month slaving away, flipping burgers at your local McDonald's. You get an email saying you've been paid $2,000, but when you check your bank account, you only see $1,456. You scroll down the pay stub and see the culprits: federal income tax, state tax, Social Security, and Medicare. This is the modern ritual of giving away a massive chunk of your hard-earned wages to invisible forces before you even get to touch it. But it makes you wonder, what actually is the currency being taxed here? The weird truth is that physical paper money doesn't hold any inherent power in the natural world. It's a fragile social construct that only works because we all collectively agree to believe it has value. To prove it, look at a digital token like Bitcoin. There is exactly zero physical difference in legitimacy between a paper dollar bill and a line of code on a blockchain. The only reason a dollar bill can buy groceries and a stick from your yard cannot is trust. Since money relies on shared trust rather than physical law, resting your entire future on uninvested cash makes you vulnerable to the system's internal friction. Value itself is entirely subjective. Think about gold. Physically, it is just a shiny yellow rock. It isn't mathematically worth more than any average stone you find in your driveway, but humans collectively desire it more, so we assign it a higher price tag. Understanding this concept is how people capture disproportionate amounts of currency. Steve Jobs created the iPhone. He packaged a massive amount of subjective utility into a single device, and millions of people gladly handed him thousands of dollars for that perceived value. It's the exact same mechanism at play in high-end retail. Brands like Tom Ford or Lanvin can sell a handbag with the same basic function as one from Target, but charge 100 times the price, purely based on the premium of perceived luxury. While money can be endlessly printed and value can be entirely fabricated, your time is your only absolute, strictly finite asset. You have a limited supply, and trading your hours one-to-one for a fixed wage without using leverage is a mathematical trap. To understand how wealth leaks out of your pocket, we have to look closely at the drains. Taxes are the unavoidable subscription cost to modern civilization. They are the fee you pay to ensure the government builds roads, maintains a military, and keeps rats out of your favorite taco truck. The government takes a slice of every dollar in motion. You face an income tax when you make money, a sales tax when you spend money, and a capital gains tax when your resting investments generate returns. Inflation is the slow erosion of purchasing power, where the numeric value of cash stays the same, but its utility shrinks. Watch how the $5 bill stays the same, but the groceries it buys steadily shrinks. This is a simple imbalance of supply and demand. If thousands of people try to buy the exact same limited television, the business rapidly raises the price tag. Governments actually aim for a predictable 2% inflation rate every year to keep the economy moving. Because of this built-in decay, holding your savings entirely in cash guarantees a slow, mathematically certain loss of your life's labor. Then there is the macroeconomic reset button, the recession. A recession is a period where the economy decreases and corporate growth dies. Think of the economy like a massive, energetic party. During a boom, everything is flowing. But a recession hits when that party suddenly goes dark. Layoffs spike and everyone aggressively freezes their spending. These painful resets can be triggered by a wide range of shocks. It might be the government actively raising interest rates to cool off inflation, a global pandemic, or a single rogue cargo ship blocking a critical global supply chain. While you navigate those massive global downturns, you also have to avoid the localized threat of bad debt. When you carry a balance on a 27% interest credit card, you are allowing compound interest to be weaponized against you. Soon, a missed payment on a $12 burrito balloons into a $50 liability. When you combine the unavoidable friction of global recessions with the aggressive trap of high-interest consumer debt, you get a system that permanently destroys the wealth of anyone who isn't paying attention. So how do you fight back? First, you need to shatter the illusion of the bank vault. When you hand a cashier your money, it doesn't sit under a dragon's guard. Banks are aggressive matchmakers. They take your resting cash and immediately lend it out to someone else. This chart illustrates the engine of the system, known as fractional reserve banking. Institutions legally only keep a tiny percentage of your deposit on hand, while lending the vast majority out to borrowers at a much higher interest rate. Your ability to participate in this borrowing system is gated by your credit score. A credit score is a 3-digit algorithm that lenders use to decide how much institutional trust you deserve based on your past financial behavior. As we see in this breakdown, that score is dictated by specific variables. It prioritizes your payment history and your credit utilization heavily over minor factors like the age of your accounts. Lenders use these weighted categories to quantify your predictable obedience to debt repayment, regardless of how much cash you actually have in the bank. By understanding these banking mechanics and fiercely protecting that 3-digit number, you stop being a cheap source of capital for the bank and start becoming a player who can leverage their money for your own growth. Your primary defense against all of these economic drains is investing. Investing is the critical pivot where you stop trading your finite hours for wages and instead deploy your capital into the active engine of the market to trade money for more money. You execute this by buying tiny ownership slices of growing companies called stocks, loaning your cash to governments through bonds, or acquiring physical property like real estate that someone else pays to live in. This graph visualizes a powerful multiplier, positive compound interest. Compound interest is what happens when your money earned a return, and then those returns start earning returns of their own. Your cash creates clones of itself, building a massive grid of capital while you sleep. But there is a catch. This mathematical multiplication requires immense patience. Ordinary people don't retire with 7-figure portfolios because they got lucky. They succeed because they consistently fed their investments and gave compound growth several decades to do the heavy lifting. The financial system contains invisible forces designed to extract value from resting capital. But by consistent, early investment with the powerful leverage of time, you can secure your future against the math of inflation.